QuickBooks Pro Plus Desktop 2022 OneNote Presentation Sales Receipt Form. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Topic Introductions tab, 1400 Sales Receipt Form tab. Also note when using OneNote, take a look at the Immersive Reader tool, Topic Introductions. They're also in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Also note that the topic introduction name and number will match a presentation. Topic introductions designed to give an introduction to the topic, provide screenshots and links when applicable, and provide some accounting background that can supplement the information within the QuickBooks presentations, noting that when you're looking at the presentations, you might then use the screenshots to help follow along with if you don't have the QuickBooks access or available in front of you. Closing the icon left-hand side, we're looking at the sales receipts starting with the screenshots, then we'll get into the accounting on down below. This is the screenshot of the home page. We've been focusing in on the customer section here. Looking at the flow of the customer section, here's a drill down, a closer look at the customer section. We're focusing now on the sales receipt type of form. We've jumped from going from this line down here, which is the accrual process, invoicing, receiving payments, to recording the deposit, to this line, which you can see kind of skips up here in the middle and cuts out these two forms before it, because this is similar to like a check register type of transaction where you're getting paid at the same point in time that you do the work, possibly in something like if you're at a store and you're selling stuff at a store, or like a restaurant or something like that. You're more on a cash basis at this point using this method, which is still a step away from using simply the bank feeds, which might be a situation where if you're using gig work or you're doing gig work or something, getting paid directly from a platform, recording the income at the point in time you receive it. This is still a step away from that, because oftentimes if you have a cash register situation and say you're receiving cash and or credit cards, you're going to have to group the credit card transactions and the cash transactions in such a way that they will need to be into the bank account in the same format as they're going to be seen on the bank statement, possibly taking the cash transactions, grouping them together, walking to the bank, recording multiple transactions from multiple different sales at one time, making the deposit in the bank at one time, therefore bank statement recording one deposit with one lump transaction, which is what you want to see in your checking account as well, so you can reconcile with the checking account. So we can't do that then by using this create sales receipt to go into undeposited funds, and this then depositing those undeposited forms in the way that we make the deposit into the checking account. Or we could decide that, for example, if we're getting sales receipts from electronic transfers or checks or something like that that are going to hit the bank in the same format as we receive them, check by check, transaction by transaction, making the sales receipt form to deposit directly into the checking account as we receive them. Those are our two options. Here's an example of the sales receipt form. It's going to look a lot like an invoice in its functionality, except that it's got this receive payment item instead of the invoice, which increases accounts receivable. So we then have cash or the check or the credit card that we're going to get, or an electronic transfer. The sales receipt forms means that we're going to be increasing either cash, the checking account, or undeposited funds, which we can determine up here. Then the rest of it is going to look a lot like an invoice, meaning the other side's going to be increasing the income account. If it was simply a service transaction, that would generally be it. We would increase the undeposited funds or checking account. Other side then increasing the sales account. If we sell inventory, gets more complicated. We're going to increase the accounts receivable by the full amount, including any sales tax, which we may have, and the U.S. sales tax often being applicable when we have inventory. And then the other side is going to go to revenue, but only for the amount that we charge, the $95 in this case. The difference is the state that is charging, in theory, the customer, not us as the business. They're just using us or making us be their collection person for them. And so that $765 is going to increase a payable account that we're going to have to pay to the state at a later point in time. And then the other two accounts that are affected, inventory going down, inventory being driven by the item here. So the system knows what that amount is, even though it's not on the sales receipt. Cost of goods sold going up, cost of goods sold and expense related to the use or consumption of the inventory in order to generate revenue. So if we go down to the transaction journal, here's the journal entry behind this transaction. Could be a good tool to use in QuickBooks, that transaction journal. I think you could find it in the reports tab up top. And then we got the balance sheet. So some of the accounts affected, undeposited funds or the checking account, depending on whether we put it into undeposited funds or the checking account, would be one of the primary accounts affected with the sales receipt. If we go into this is the checking account, then normally we got the increases to the checking account being deposits. In this case, it would be a sales receipt. So this would be a different kind of form for the increase if we put the sales receipt directly into the checking account instead of going through the undeposited forms, undeposited checks, undeposited cash. So then we got the ordinary income. On the income side, we'd have an income account that's going to be increasing. If we drill down on the materials account, for example, you can see that these are increasing mainly with the invoices because this particular company uses the invoice instead of the sales receipt, mostly because of the type of business that they are in. The difference then would be in the sales tax. We're back to the balance sheet. Sales tax increasing because we had to charge the sales tax. It increases a liability account. Sales tax doesn't hit the income statement at all because it's not really our charge, and therefore we don't have the revenue and expense netting out on the income statement, but rather it going directly to the balance sheet. And then we've got the inventory account that would be impacted as well if we were to be selling inventory with the sales receipt. Inventory account looking something like this. Again, this company typically has the inventory impacted with the invoice. That would be the sales transaction that would be decreasing because they don't use the sales receipt a lot. But if you were using the sales receipt, it would be a decrease to the inventory at that point in time. And then we got the profit and loss, which would be the cost of goods sold, which would be impacted by the sales receipt if you were using it to sell inventory. Let's take a look at the debits and credits of it, just in terms of debit and credit format. So we're focusing in on this sales receipt type of transaction. Now, again, there's two kinds. Let's think about the most basic type of transaction we can do with the sales receipt. Imagining we're at like a food truck or something like that, or service item that doesn't have any inventory at all, and we're basically providing a serving, getting paid cash at the same point in time, and we want to put it directly into the checking account. That would be the easiest type of transaction, and this would tie into what normal accounting would learn. If you were learning accounting like a classroom with debits and credits, this would be like the easiest sales type of transaction. We got paid at the same point in time. And when we think about it in a classroom, we usually don't think about this problem of having to take the undeposited funds and match them so that our reconciliation works. We just think of it as cash. In practice, we got to think about that because the bank reconciliation is important. But first, we'd say, okay, that when we made a sale, let's say we increased the checking account by $1,200. The other side just going to revenue. That would be supporting a sales receipt type of transaction where we're putting the receipt directly into the checking account and we don't have any inventory involved. Checking account, if we then say this is our beginning balance, left-hand side, entries, adjustments in the middle, ending balance on the right, the checking account would be going from $100,000 up by $1,200 to $101,200. Other side then going to revenue, starting at the $200,000 credit, $1,200 up to $201,200. Looking at the net income being the revenue minus the expense accounts at the $24,710. It goes up in the credit direction, the brackets being credits, not negative number, not a loss, to $25,910. The GL account then, $100,000 for the checking account went up by the $1,002 to the $101,200. The sales account is going up from the $200,000 up by the $1,200 to the $201,200. So then let's think about the next little bit more complex transaction. Imagining we're using the sales receipt but not putting it directly into the checking account when we have it, we would change this item up top to be putting it into undeposited funds. So let's say we had a service like a massage business or something like that, and they're given where service happens at the same time, no inventory is involved. We got cash at the point in time that service is taking place, and we're going to be collecting that cash for multiple different clients during the day, and then go into the bank at the end of the day and depositing in one lump sum. Therefore, it's showing on our checking account in that lump sum. Therefore, I don't want to take each transaction and put it directly into the checking account, but rather into undeposited funds, and then do the next step, transferring it into the checking account in the same format as the deposit will show on the bank statement. So in this case, then, the only difference being, instead of debiting checking account directly, we're going to debit undeposited funds, a holding account or clearing account, not a temporary account. There's a difference. A temporary account represents the income statement accounts, which are temporary because they close out at the end of the month or year, to the equity account. A clearing account, such as the undeposited funds, is an account that we're going to increase and decrease very rapidly in order to have some specific function that we're going to be using it for. In this case, to group the deposits together in such a way that they will match what's on the bank statement. So if we posted this out, we'd say, okay, undeposited funds is going up instead of the checking account. Also note that this is something that you don't see as much if you're doing the accounting in a school room, because they basically will combine these both into cash and not deal with this kind of issue of depositing in the grouping that it needs to be on the bank statement. So just be aware this is a problem or an area that you got to kind of expand on when moving from normal debits and credits to software. And so then that's going to increase to 900. Then the other side would be in the revenue. So now we got the 200,000 increasing by those two transactions, by the 2001 to the 2021, the net income going up. If we look at the undeposited funds, it went from 0 up by 900 to 900. The revenue went up by 200,000. It was at 200,000. It increased by the last sale, 1,200 to 2,012. Increased by this sales receipt, 900 to the 2,021. So now we're going to imagine the situation where we'll stop it there. So in other words, now we stopped it at this area at the 900. The next step would be to make multiple more sales during the day. Take those sales, imagining we got them in cash, and then deposit them into the checking account. And what we would do then is clear out the undeposited funds, crediting the undeposited funds, and then debiting or putting them into the checking account. In QuickBooks, that would be done with the deposit form. Okay, so then the next thing that we'll take a look at is say that we have the same kind of transaction. We're going to put it directly into the checking account with a sales receipt, but now there's inventory involved. So it's going to be the same kind of thing that you saw with the invoice, which is actually a fairly complex transaction. And instead of putting it into undeposited funds, we'll put it into the checking account. So that's the same option we had up top. What do we do here? Do I put it into the checking account or undeposited funds? I'm going to put it directly into the checking account this time. And then we'll record the inventory. So if you got inventory, then you know the checking account's going to go up by the cash we're going to receive. Then the next thing we might think about is the sales price. So the sales price we're going to say is $2,500. Now, how would we know what the sales price is? In QuickBooks, we would know what it is because it would be something driven by the item. So in other words, these items that we would set up have to be set up properly so that the system knows what it is we're selling and the sales price of it. Now, if you imagine scanning something in like the grocery store, you see the sales price pop up. What you don't see is going to be the cost that's basically going to pop up. So if you have the sales price, then we're going to have sales tax possibly that's going to be charged on it. So I'd say 2,500. Let's imagine that the sales tax is 5%. So we're going to imagine another $125. That $125, it's not charged by us in theory. It's charged by the state or local government. And they're making us be their collection agency for them. So we have to collect it on their behalf. It's a tax in theory on the customer. That means the amount that we're going to charge the customer and receive at this point is going to be the 125 plus the 2,500. So this is the amount that we would receive. And you could see that if you were to scan something like a grocery store or something like that, you'd see this side of the transaction would basically be apparent. The side that would not is then the fact that the inventory would have to go down. How would the system know what the inventory is? By the items that have been set up, even though we wouldn't know that on our side when we enter the transaction. So that's why the data input can be very easy, even though the transaction can be somewhat complex. And then the other side would be inventory going down, and then the cost of goods sold would be going up. cost of goods sold being an expense of us consuming the assets of inventory in order to generate the revenue. So the net income impact would be the 2500 minus the $2,500 net impact bottom line on the income statement from this transaction. So, and just one more thing, just realize this sales tax often confuses people because people often think, well, I'm paying the sales tax at a later point. I would expect to see some kind of sales tax expense down here on the income statement. But you don't have the sales tax expense because when you charged the sales tax, you didn't recharge it as revenue. You could think of a system where we'd say, I'm going to include the sales tax and just include the revenue at the $2,625 down here in revenue. And then I'm also going to record the expense of me doing business, taxes, paying the taxes. Now that would make sense, but that would kind of indicate that you are the one that are being charged the taxes, right? You charged the sales price to what it was, and then you paid the expense of doing business, paying the taxes. And that might be the way it really is in practice in the real economy. But in theory, you're not the one paying the taxes. The customer's paying the taxes, so it shouldn't be on the income statement. That's the idea. So that means when you make the sale, it goes directly to the balance sheet account of the liability account, and there is no impact on the income statement on the revenue or expense side. Okay, let's post this out. Checking account would be going up, starting at the $100,000, going up by the $3,825 from the transactions that had been taking place here and here to $103,825. The other side would be on the income statement included here. So the $200,000 going up by the $4,600 to the $204,600, which is including the sales transactions here, here, and here. And then the difference between those two is the sales tax payable liability account, increasing on the liability side to $125 that we'll have to pay at a future point. And then the cost of goods sold down below. Here's the cost of goods sold and expense account going up from $160,000 up by $2,000 to $162,000. And finally, the inventory going down $4,375 going down by the $2,000 to the $2,375. So then if we look at the impact on the accounts, then the GL accounts, the checking account went from $100,000 prior transaction up by $1,200 to $1,012, then up by this transaction to $2,625. This one including the sales tax that we're going to receive to $103,825. Sales tax payable going up by the $125 to the $125. The sales was at $200,000 starting. It went up from the prior transaction $1,200 to $201,200, then up by $900 to $202,100, and this time up by $2,500. Not by the full amount that we're going to get or we got in cash, but by the amount we charged net or after sales tax, not including sales tax, $204,600. Cost of goods sold went up. Expense account, $160,000 up by $2,000 to the $162,000, and the inventory goes down, $4,375 down by $2,000 to the $2,375. We've got the subledgers then for inventory. We also want to track the inventory not just by the dollar amount that it went down by, but also by the units. So we need some kind of subledger. How would QuickBooks know how to do this? It would then have set up, and these accounts or these items would help us to track the items that were sold as well. So then when I enter the transaction into the form, the data input fairly straightforward. QuickBooks then doing this work, which I'm not going to get into detail in terms of the flow assumptions, but just note you need some kind of flow assumption, either specific identification, first in, first out, last in, first out, weighted average. QuickBooks Desktop typically uses weighted average as the default. So in other words, if we started with 50 units, so we got two kinds of inventory, we're saying inventory item 1 and 2. We started with inventory item 1, 50 units, $50. That multiplied out comes out to the $2,500. We're assuming we sold 40 units at $50. $2,000. That's where the $2,000 cost comes from. That's the cost of goods sold. That's the decrease in the inventory. That is not what the sales price is. We might use the cost in order to generate the sales price, but that we're tracking right here, the cost is what we're looking at here. And then we're going to say, then what's our ending balance? Well, we had 50 units minus the 40 units. We got 10 units left. We have the 2,500 total minus the 2,000. There's the 500 left. and the unit cost is still 50, we have no issue with the flow assumption because it was the same price. It's been the same price the whole time. So it doesn't really matter which flow assumption we're using in that case. And we could talk more about flow assumptions later. That's a whole topic in and of itself. But the point is that you need to track some kind of subledger if you're tracking the inventory in the system. Now we have item 1 of inventory, item 2 of inventory, summing up to, in dollars, the $1,875 and the $500 or the $2,375. That ties out to the general ledger, $2,375. So if we looked at this whole process then, and what QuickBooks is actually doing when we enter the forms, such as the sales receipt forms, QuickBooks is doing this on the left-hand side, entering these journal entries, and then QuickBooks, what it's doing magically that we don't really see is entering that data into the general ledger, and as it enters it into the general ledger, it's also creating the subledgers when it needs to by forcing us most of the time to enter the data using the forms that it needs to do that, in this case forcing us by using the inventory items in order to support the inventory account in the subledger so that we can generate those subledger reports. That general ledger then is used to create the trial balance. Now I've broken out the trial balance for these few transactions, beginning entries and ending, so you could see the impact directly a little bit more specifically on these accounts. But generally you would think of it as being created from the general ledger, and then that trial balance would of course be used to create the financial statements, balance sheet, income statement, the statement of equity. How you would typically use QuickBooks then is to set it up, use the QuickBooks forms in order to do the data input, such as the sales receipt, then jump on over to the balance sheet or the financial statements, balance sheet, income statement, otherwise known as the profit and loss, possibly then drill back down to the source documents that were used to create it, such as the checking account, double clicking on it, going back down closer to the source document, such as the general ledger report, which would look something like this, which might be called a transaction report by date or something like by account or something like that in QuickBooks, giving us the information by date. You might do the same thing for something like an inventory account, for example, and then you might say, hey, I would like to see it not simply by date, but by inventory item, in which case you would generate another report, which can be thought of as a subsidiary ledger or a subsidiary report, in this case, an inventory summary report or something like that, giving us the information not only by dollar amount, but in this case by the types of inventories, the flows that we have, it being subsidiary because the total of it should tie out to what's on the balance sheet, to what's on the general ledger, to what's on the transaction detail, to what's on the TB trial balance.